Hey everyone, welcome back to BP News. I'm Dave Meyer, and I hope you all had a great Memorial Day weekend. Today, I'm going to share the most important financial and investing news from the past week. On deck, we have three important stories for you. First, massive increases in the Case-Shiller home price index. Secondly, mortgage prices dropping even further than they've already been. And lastly, another good month for the stock market. Before we get started, please make sure to subscribe to the BiggerPockets YouTube channel and give this video a thumbs up. We really appreciate it. Okay, let's get into it. Our first story this week, the Case-Shiller index, which is one of the most reliable measures of housing prices across the US, was up over 13% in March. This was the largest increase in almost 15 years. Phoenix led the way with 20% year-over-year growth, followed closely by San Diego and Seattle with 19 and 18% growth, respectively. The West presented the strongest gains, but every region in the United States posted double-digit gains for the year ending in March 2021. Now, we all know housing prices have been going through the roof, so this is really not huge news, but seeing it in these stark terms is pretty incredible. The news actually prompted Robert Shiller, the Yale professor, Nobel laureate, and one of the inventors of the Case-Shiller index, to state on CNBC this week that he's worried about the state of the housing market. He actually thinks that prices might go down, but not as a crash and not for at least a year. He thinks it's going to take a little while, things keep going up, and then we'll come back down gradually. He also pointed out that although the environment feels a lot like the last bubble, there are much better protections in place and far fewer risky mortgages that could undermine the stability of the entire housing market. Instead, this current run-up, at least in my opinion, is driven by high demand, low supply, and really low interest rates. While investing in today's hot market is absolutely more risky than buying into a buyer's market, most experts believe that housing prices are going to continue to increase, which offers investors potential returns, at least over the next year, while inventory remains low and debt remains so inexpensive. This brings us to our next story. Mortgage prices are back below 3% and remain insanely cheap. If you haven't refinanced a property already, now would be an excellent time to do so. Honestly, I am surprised that mortgage rates have remained so low this far into the economic recovery. Mortgage rates, after all, are based on two primary factors. The first is the federal government's federal funds rate, which are at about zero, so can't go much below that. And the second factor is bond yields, which were rising at the beginning of 2021, but have stabilized in recent months. With short-term inflation fears mounting, I was expecting bond yields to rise modestly over the last couple of weeks and take mortgage prices with them. But that has not happened. Instead, mortgage rates last week actually dropped 5 basis points and now rest under 3%. These low interest rates are very attractive to real estate investors, particularly with potential inflation on the horizon. As I talked about a couple of weeks ago, real estate is a great hedge against inflation, particularly if you're able to lock in a low interest rate on a loan prior to an inflationary cycle, and that is exactly where we are right now. On the flip side though, these low rates are not all great. They are also fueling this crazy and, by most accounts, unhealthy run-up in prices that we are seeing across the country. So as long as these mortgage rates remain so low, there is very little hope for short-term relief in this market crazy appreciation. The bottom line for investors, though, is if you're looking to invest, if you're trying to get into the market right now, mortgage rates are about as cheap as they are ever likely to be. As long as you are investing for the long run, these mortgage rates bode really well for your returns. For our last story this week, the stock market posts its fourth straight month of gains. Despite huge volatility in the crypto market and inflation-fueled fears earlier in the month, the stock market ended the month with modest gains. Posted a 0.1% increase, with the Dow Jones and S&P 500 posting very similar gains. On the other hand, the tech-heavy Nasdaq posted a loss as tech stocks appeared to be particularly vulnerable to inflation worries and were mostly down in May. Now, we're not talking about huge gains here, but given how the month started with a ton of volatility, it is notable that the markets actually finished up, albeit modestly, in May. For now, it seems that the equities markets have become comfortable with short-term inflation remaining pretty high. and they seem confident that the Fed will raise interest rates slowly, if they raise them at all. Investor confidence seems to have been bolstered by all this, as well as other data suggesting a strong economic recovery. In April, consumer spending, the biggest indicator of economic demand, was up 0.5%. That indicates that GDP and corporate profits are likely to keep growing, potentially taking the market up with it over the next several months. We'll have to wait until mid-July to get Q2 earnings to gauge if profits are actually growing and by how much, and there's likely to be continued volatility until then. One thing to watch for in the meantime is whether the Biden administration and Congress pass an infrastructure bill, which could further bolster a whole slew of stocks poised to gain from infrastructure spending. Okay, that is it for me this week. I'm Dave Meyer with BiggerPockets. Thank you so much for watching, and I'll see you all next week.